Let's take a look at preparing an income statement. An income statement, also known as an operating statement or profit and loss statement, is a summary of the operations of a business over a period of time, usually a month, a quarter, or a year. The revenue section of the income statement represents the primary source of money, both cash and credit, flowing into the business from its customers for goods sold or services rendered. Gross sales are the total sales of goods and services achieved by the company during the operating period. Sales returns and allowances is the amount of merchandise returned for cash or credit by customers for various reasons. Sales discounts are cash discounts given to customers by the business as an incentive for early payment of an invoice. For example, 315N45, where 3% extra discount is given if the invoice is paid within 15 days rather than the net date of 45 days. Net sales is the amount received after taking into consideration returned goods, allowances, and sales discounts. Merchandise inventory, beginning of operating period, is the total value of the goods in inventory at the beginning of the operating period. This beginning inventory is the last period's ending inventory. Net purchases are the amount at cost of merchandise purchased during the period for resale to customers after purchase returns and allowances and purchase discounts are earned and deducted. Freight is the total amount of the freight or transportation charges incurred for the net purchases. Goods available for sale is the total amount of goods available to be sold during the operating period. It's the sum of the beginning inventory, net purchases, and freight in. Merchandise inventory, end of the operating period, is the total value of the goods remaining in inventory at the end of the operating period. This ending inventory is the next period's beginning inventory. Cost of goods sold is the total value of the goods that were sold during the period. It's the difference between goods available for sale and the ending merchandise inventory. Gross margin, also known as gross profit, represents the difference between net sales and the cost of goods sold. Total operating expenses are the sum of all expenses incurred by the business during the operating period except the cost of goods sold and taxes. Operating expenses differ from company to company. Some typical examples are salaries and benefits, sales commissions, rent and utilities, advertising and promotion, insurance, general and administrative expenses, depreciation, and miscellaneous expenses. Income before taxes represents the money a company made before paying income tax. It's the difference between gross margin and total operating expenses. Income tax is the amount of income tax, both state and federal, that is paid by the business during the operating period. Net income, net profit, or net loss is the bottom line of the income statement. It's the difference between income before taxes and the income tax paid. Keep in mind that an income statement covers a period of time, whereas a balance sheet covers a moment in time.